Okay, so I'm going to talk about 4 strategies specifically today. There is calculate your EFC. If you don't know what that is, I will tell you.
Claire.
Yes. Yes.
I can't hear you, Pat. You're on mute. Maybe.
Okay. I'll keep, if you want to chime in and have a question, don't just chime in. You do not need to raise your hand or write it into the chat. We've got a small group today, which is great. So calculate your EFC. I'll talk about that in just a second. Use net price calculators. These are super handy and every single college website has them. Understand how assets affect aid. This is a huge question we get from clients all the time. And you know, there's good news and bad news, but the good news is it's not as much as you might think. And then know where your college money comes from. So diving into that first one, we'll talk about EFC. Any questions? All right.
Nope.
So the EFC is your expected family contribution. You might have heard this from college counselors or high school counselors or seen it on a FAFSA if you already have a kid in college. This is pretty much how much you're expected to dole out of your own assets each year for college. You do have to calculate this every year, just like you have to apply to things like the FAFSA or the CSS every year. So this, what does it include? It includes pretty much everything that's not a retirement account. And you have a great calculator available to you at College Board. And again, we're gonna send all this stuff around to you guys after we're done. So this link will be in there. And yeah, you just need things like things you'll find on your taxes, income, assets, your kid, information about them. It's all pretty straightforward and they'll give you a really good number for, you know, what you are expected to dole out. So let's do a quick example. This is just a very general Bay Area family. Their AGI on their tax return last year was 220. They have about 150,000 in cash and investments, and they have about 600,000 in their equity. They have 2 kids. One is going to be a freshman and one is a 12-year-old. So going through that College Board calculator, we find that their expected family contribution is around 34,000. You'll see 2 different numbers here. You have this one right here and this one right here. So the first one, that federal methodology that deals with basically the FAFSA. This is government money that you're going to want. This is mostly need-based money, and it applies to every single college that you're going to apply to. The second number over here is institutional methodology, and this applies to more of the colleges, mostly private colleges, that will have their own money that they will give out for merit-based and need-based scholarships. These are mostly the colleges that you think of, right? The Stanfords, the Harvards, the not even just all the Ivy League schools, but just any of the schools that will have kind of an endowment to be able to give money will use this additional profile. Okay, so we've determined that their expected family contribution is $33,500 for that one kid for that 1 year. Let's look at 2 different colleges. The first one, we have a public college. This is maybe a state school, a California State School, CSU. You know, I just used a random number, so this is not an accurate number of, like, say, Berkeley, which I'll get to later. But so let's just say it's 30,000. Your expected family contribution is higher than the amount of the tuition. So in that school's eyes, you do not qualify for any need-based aid. However, all is not lost. You do still have the ability to get merit-based aid. Now, if you look at private colleges, because they tend to be more expensive, you still have that same expected family contribution. And now you do have a demonstrated need of about $31,500. So you qualify in the university's eyes for both need and merit-based aid. Any questions on that?
Nope. Okay.
Cindy, I feel like you can give some pretty good examples, right? You've already gone through this. Okay, so So what do you do with that, right? So you know how much you are expected to shell out. What we're trying to do is make college super affordable. So what we're going to find is colleges that will make up that difference for you. We want to find as much of that 31,500 as possible. And we do that using net price calculators. Now, every single university is required, federal law, to have a net price calculator on their website. It's on there. You can usually just use the search button and say net price calculator and it'll pop right up. If it doesn't, you can just let me know. I can look for it. Sometimes there's like weird search terms, but it's usually very easy to find, and usually in that like tuition section. So that being said, a net price calculator will do this calculation for you. Hey, this is what we say our college is going to cost every year. And then this is you specifically, your kid, your income, your assets, how good are they in school, things like that, what kind of merit and need-based scholarships and grants they qualify for. And then this is your specific price. And so obviously this is a really powerful tool. If you're worried or have constraints on money for college, these are or have more than one child, like sounds like we all do. This is really important, right? Because we have a budget, and maybe you could spend $200,000-$300,000 for school, but nobody really wants to. So these are fantastic. What I recommend doing is to use these calculators before your child applies for school. I haven't had to do it yet, but I can't imagine letting my son, who's now going into high school, to let him apply for something, for him to get in, and for me to say, I just don't know if this is going to work, right? So it may be a good thing to steer them kind of in the realm of where really great schools can be just a little bit more affordable, and it doesn't have to be a surprise.
And Claire, quick.
Yeah.
Does the calculator assume the out-of-pocket cost, or maybe the better question is the unexpected costs? Because you got the main ones like tuition and fees.
Yeah. So they do include the whole entire, like, this is how much it'll cost to go to college. I'm pretty sure that most calculators assume the room and board is at the college for the first year. And so they calculate that rent in. I think it's just more of a known than it is like if you just go get an apartment somewhere. So, I'm sure there's variance, but they do include the whole number, not just the tuition itself.
Yeah, and that's a good point, because sometimes students, maybe after the second or third year, want off-campus housing, and so that changes a little bit.
Yeah, definitely. Yeah, and these calculators are geared more to the people that are looking for the school that they're going to go to, not like planning for it after they've attended. Great question though, Matt, thank you. And so, as the ever curious parent, I actually use these net price calculators myself to do detective work, and maybe a little gentle prodding. So for example, I was talking to Hank and I'm like, hey, if you got a 3.9 instead of a 3.5, you could go here and it would be pretty awesome. So, I mean, that's kind of jokingly, but you can look at your children's strengths. They're very good in grades. Maybe they have a fantastic swim competition track record. It really depends on what your child's strengths are, and you can look for schools that will pay up for that. And there are thousands of wonderful schools out there. Whatever your kid is really passionate about or really good at, be it, coding or Spanish, there are schools that will specifically want those things. So, good net price calculators will take all of that into consideration, as well as SAT scores, which I know are kind of being phased out, but as of today, they are still implemented in the calculator.
Okay, Pat has a question, I think.
Yeah.
We can't hear you, Pat. It's just mystifying.
You want to type it?
The audio ghost is taking Pat's voice.
Yeah, if you want to type it, Pat, we can circle back to it. I
Okay.
don't know.
All right. Well, if you want to throw that any questions in the chat, I'm happy to answer them. I will just keep an eye on it. Okay.
Or is it
Um,
a volume issue maybe, Pat? All right.
Hope he
Moving
comes
on.
back. Okay, and moving on. So the net price calculators, if you have the gumption and the time, they are a good tool to use to try to like steer your kids down roads that maybe are going to cause less stress, but also give them the full experience that you want them to have in college. All this, I'm singing the praises of net price calculators. I will say that about half of them are terrible. Because they are federally mandated, they have a very bare bones template that the federal government would give you in order to pass that regulation. Those are terrible, and you will know that they're terrible if they don't ask about things like GPA, test scores, or extracurriculars. Okay, if you are not being asked about these questions, then you are only being considered for needs-based aid. But luckily, most of the colleges that we want to go to, most of the ones that have CSS profiles, those are all really good calculators, because you know what, they want you guys to come, right? They do want students to enroll. They don't want parents to be upset about the price. They don't want people to be deterred from their sticker price. And so it really behooves colleges to have these things kind of very detailed and accurate. Okay, so this is a huge question for people. How do my assets impact my aid? We worry about these things. Honestly, it's not as much as you might think. So when we talk about how assets impact aid, there's two different ways, two different profiles. We talked about them a little bit before. One is the government, and one is kind of that institutional money. So the FAFSA, the free application for federal student aid, is going to calculate your needs based on need. That was a terrible way to say it, but you know what I mean. And then you have something called the CSS profile, which will the institutions themselves will use to give out their own money based on need and merit. So these two profiles look at assets just a little bit differently, and we'll go into the differences right now. We'll start with the FAFSA. So the FAFSA doesn't count a lot of things. I'm just going to say a blanket statement. The FAFSA doesn't count retirement stuff, and then also insurances, and also annuities. How do you like that for a blanket statement? Oh, and equity and income. So essentially all they are going to count is your brokerage, your cash, your education plans, the tuition plans. If you are in somewhere like Florida, or have a state where you pay into going to college in that actual state, those are all counted. Any custodial accounts, if your child has an account that maybe an aunt or a friend has been putting into that they'll get when they're 18 or 25, those will count to financial aid. And that's a big one, and we'll cover that in a minute. Obviously, any checking accounts, basically anything that you can't be tax deferred or isn't otherwise for your own specific retirement, they're going to want to look at. Now, how do we differ? So just like the FAFSA, we're not going to look at retirement accounts, right? The government does actually want you to retire comfortably, which is good, right? That you were saving for that, and we don't want you to tap it. We as financial advisors don't want you to tap it, and you know the community at large is better off if everybody is a bit more self-sustaining in older age. So these things are not included and not kind of on the table for people to discount against aid. Okay, but the CSS profile is more detailed. Instead of not including any annuities, they do count non-qualified annuities. So if anybody has a non-qualified annuity, come talk to me. If you have a business, they do count the adjusted net worth. They do count cash value on life insurance most of the time. And they do count equity in your primary home. Now, both the FAFSA and the CSS include equity in your rental properties if you have them, and also the income from that. So that's just a good thing to know. Any questions? Pat, can I hear you?
We can't hear
Nope.
you.
I'm gonna call you. Okay, so that's the FAFSA. Oh, I went too fast. So I keep saying they don't matter as much as you think. And what does that mean? So for the FAFSA, you can only, like, the most that you can be assessed for your assets is 5.64%. The most that you can be assessed for your assets on the CSS profile is 5%. What the heck does assess mean, right? So looking at your whole pie of the stuff they're including, I guess not like that, it's like that. 5.64 of that is going to go to college, right? So if they're assessing it, that means like you've got to pony up 5.64% of your assets that we totaled up. That's your
Per
contribution.
year?
Yes,
And
it
that's
is.
per year, right?
It is. Yeah. These are assessed every single year. Yeah.
And they really look at it as a one-to-one. So even if I have 3 kids that I have to pay college for, they don't care. That total asset is really.
Yeah. So right currently, before some of the changes that are going to go into effect in 2022, 2023, you do get a discount for kids that are already in college. That is going away. And we can talk more about that offline, because there are a lot of changes that are going into effect that, unfortunately, even though I advertise it, I don't think we're going to have time on this specific presentation. So there's a lot there though. So give me a ring. Yeah. So the FAFSA and the CSS profile don't really assume that you're going to be spending all of your money on college, although it feels like that's what happens. If you look at your custodial accounts though, if you look at your kids' money, they do expect them to spend quite a bit of their own assets on college. And you can see off to the side here, with the FAFSA, it's 20%, and with the CSS, it's 25%. So if you have a custodial account, 25% of whatever is in that account is expected to go out the window. Well, not out the window, but like to the college. Terrible phrasing. And so that's a good point to know. If you have a kid that is kind of coming of age, maybe it's worth a discussion on what's the best thing to do with those assets before they turn 18. And that's just another reason for a meeting. So we talk about assets and how to shelter them and how to hide them. But at the end of the day, not only does it not make or break whether or not you're going to pay a bunch or even be eligible, but it doesn't really affect your aid in any large way. You can see the slide here. For every $10,000 you save, you're only reducing your aid by $564. So, we will be strategic, we will have a plan, and we will definitely manipulate anything that's available to us for you. But at the end of the day, saving is saving is saving. And it's like that pretty much with everything, right? With retirement, with homes, with kids, yeah. And, surprisingly, and this was a surprise to me as well, when I started researching everything, it's not so much the assets, it really is the income that makes a huge difference in whether or not you qualify for needs-based aid. So with a lot of people, and certainly our clients, we do all the calculations for your assets, but in the truth, like, you just go over the threshold of income before we even get to count up your assets. And so for those reasons, it is really important to listen to Brandon when he tells you to max out your retirement accounts. He's telling you to do that for a reason. It is multi-folded, and this is one of them. And 2, you should be pumping as much as you can into things like 529 plans and other accounts that will give you the most bang for your buck when it comes to college saving. Okay, so we're moving along. Where does all of this money come from, right? We're already kind of circling around the idea that maybe We have to look at more needs-based with like more expensive tuition colleges, maybe private colleges. This is something that we're going to be concerned with. If you go to a state school or if your EFC is just really high, we're really going to be looking at merit-based awards. So where do we get those? The government does most all needs-based aid. An example that I know dearly is the Pell Grant. And institutions will do primarily merit-based aid. And that's not just to say, like, I have a 4.2 and, you know, at you know, top SAT score. Merit is across the board. It can be, it's not just grades or test scores. It's everything, extracurriculars, everything. And it's really just their own pool of money that they get to decide who they give their money to. So they do have needs-based aid that they give away, but they also have merit-based. And for more affluent households, as I kind of alluded to earlier, we do want to look primarily, not primarily at merit-based aid, but it is usually what we end up going after. And so to narrow your search, to know your AFC, to be able to narrow your search, to know what schools kind of you're in the ring for the most aid, be it merit or needs-based, is the first step. And you know, you hear all of these news articles or people on TV talking about how college is more competitive than ever and it's more expensive than ever. But in a whole, if you're looking at all colleges, it really is a buyer's market. It may not feel like that, but if you cast a bit of a wider net, then it really is, because you have these very fierce recruiting opportunities that are going on. This is an actual, I love this. This is an actual billboard. It was from 2019 and it says, "Go to UMaine for the in-state cost of UConn." That is a very aggressive billboard, but it does highlight the fact that these lesser talked about colleges are fighting for enrollment, right? So they're saying like, yeah, you think in-state is the cheapest way to go, but you know, you can go over here and it's going to be less expensive. So they're very competitive just to get people in the door. And the fact is that since 2008, enrollment has been dropping across America. And you know, when it comes to the state schools, even the very, very popular state schools, the state budget has gone down. I mean, after the Great Recession, but it has still not recovered fully. And then the pandemic hit. So a lot of colleges are reconsidering the ways that they will get enough people in the door. And some of these places, state schools in this example, they want out-of-state students, right? Like they can charge you a little bit more. Yes, you'll get residency in 2 years, but they are really trying to get that bottom line. So just understanding the psychology of where the colleges themselves are can save you a bit of time when you're trying to narrow down your search. You know, we always think about UCs, and this is a great example. So we talk about how college is super expensive and it's more competitive than ever. These are the colleges that it's more competitive than ever for, right? So if you have more students than you can ever admit, then you don't really have to charge less and you don't really have to give aid because you have a huge amount of people coming in. You're not suffering from the same things that other universities are. And that goes for places like Berkeley and University of Virginia, University of Colorado, all these well-named schools where they're, you know, state schools, but they're still a little bit more expensive than you might think of if you go to a different state, you know, maybe Iowa or Georgia or any of the other states. So I alluded to this earlier. To cut costs, you want to cast a wider net. We all have about 200 to 300 schools that you just know right off the top of your head. And you know, there's thousands of really, really good schools, private and public, that are really vying for your kids to attend. And you know, these things can often be more intimate The professors more friendly, they're not so overwhelmed, they have less, student teachers, so you get more one-on-one time. It's just a consideration if you're looking at something that's the best fit for your kid. And then, just most elite schools have the highest price tags, right? We know this, and they give little to no merit scholarships because, again, they don't have to, right? So, and if most elite colleges do offer the best financial aid. So these things go in tandem if you think about it. The people that can pay full price do, and for the people that cannot pay full price, they do get all the need-based aid. And so it is very offset. And so if you're looking at these elite research or private institutions, you are going to have a harder time. Not to say that it's impossible, right? We have plenty of clients that have gone to very prestigious schools and done well, but it is not the only road for your child. And there are plenty of other places that would be good fits. So this is a great example. So these are some top research universities. Boston College, I see, alma mater for our lovely Shannon.
Oh, Boston University.
Boston University, sorry.
Yes.
Sorry. So Boston University, they give some sort of aid to 53% of their incoming freshmen. That means 47, wait, 47? 37. Means a whole lot of people are paying full price to go. Well, I did the math for the university college, but anyway, it means that a whole lot of people are paying full price, right? Like they don't have to give these merit-based scholarships or even needs-based scholarships if they don't need to, because they have plenty of people coming in. Meanwhile, the rest of the private and public institutions are giving something like 80% of their incoming freshmen discounts and merit-based scholarships and need-based scholarships. So there is plenty of money. It's just disproportionately in the places that you actually have to search out to find. So we wrestle with this, and I do myself also as a parent. Won't the Ivy League school get me like this, all the connections, and I'm setting my kid up for life, and I won't, there's no way to tell what school is going to be better for who, but Alan Kruger is a Princeton economist. He's very famous. He wrote this very famous Ivy League study where they originally were looking at happiness, like what makes people happy. And they were looking in college because he has a ton of college students to practice on. And, they were asking questions, and they did a cross-sectional longitudinal study on Ivy League students who graduated from Ivy Leagues, and then also people who didn't. And they had two really resounding conclusions that they came from those studies. And they're right here. I'll just read them off to you. I gotta close that little. So students who graduated from the Ivy League schools and those who were accepted from the Ivy Leagues and decided to attend somewhere else, they ultimately made the same amount of money over their lifetime. Then students who graduated from Ivy League schools, as well as the students that didn't get into Ivy League schools, but still had really good profiles, they also made the same amount of money. So it's really not, it's not the school, it's your kid. And that's what the data suggests. And, there's a lot of emotion tied up in that, but I think that the data it's pretty relevant, right? Especially if you're talking about how to go to college without going broke. So this is just a quote from Alan. Students who apply, go ahead.
Was that a whisper of Pat?
So students who apply and are accepted by elite schools are likely to be high achievers. High achieving students are likely to have high earnings regardless of where they attend college. So why even bother? Who benefits from the Ivies? And this isn't too surprising if you think about it. The research shows that the first-time college students, the low-income minorities, they really do benefit the most from that brand name degree because they don't have the community connections. They don't have college parents that have already gone to college that know how to navigate it. They don't have a lot of those things that are already in place for a lot of our kids. And so that name brand really does go a long way for them. But for kids that already have a lot of that stuff in place, sometimes it's not worth the huge price tag that you get on it. So what does matter? And I think about this all the time, right? What actually matters is their actual experience in the school, not the name of the school, but what they do while they're there. So did they have a professor in college that was super engaged? Were they engaged in extracurriculars? Did they have a mentor? Did they get internships? These like smaller experiences within the overall college experience is really what they're going to remember when they're out of college. So that's something to consider. Okay, so those are takeaways. So know your EFC, right? You have a great calculator on collegeboard.com. Use those net price calculators before your child applies. Cast a wider net and maximize those accounts for student aid. But remember, it's not the end of the world, and income is really going to matter more than anything anyway. And then finally, find the schools that give your kid the most money for them to attend, and not the other way around. Again, I mentioned this earlier, there's a ton of changes that are going on with the FAFSA. We don't have enough time to cover them in today's talk, but you can email me if you're interested, or just give us a call. We can set up a time to Zoom, or I can just chat with you on the phone about it, and we can talk about your situation specifically. Again, I'm in the trenches with you guys, so you can ring me up anytime, and I guarantee I'm going to have some good information for you.
I will probably take you up on that offer.
I hope you do, Cindy. I hope
do.
you do. Yeah.
And Claire, I guess I have a question.
Yeah.
For, I went to college back, shortly before the Spanish-American War, so things were very different back then. But I mean, how we, being a very merit-worthy and needs-based student, got a lot of aid. And that's how we decided where I went. It wasn't which one do you want to go to. It's like, which will pay us more for you to go, or pay less for, So
Yeah.
how accurate are those calculators? Because those did not exist back in days of yore. So how
Right, so
accurate are they?
that's a great point. And I had that slide saying, like, look, half of them suck. And if they don't include things like GPA, extracurriculars, SAT scores, they are not calculating merit scholarships or grants or loans or anything. They are not looking at merit whatsoever if they're not asking you questions about merit, right? So know that is happening. Everybody will have a calculator, but those are things that you can also ask any college counselor. You can email the admissions team. They have that information for you. You just have to ask for it. And that's kind of like, those are the secrets, right, that nobody talks about. So they have that information for you. They can calculate these things for you. Calculators for most of the schools that you're going to be looking at are going to be good. And if they're not, then they can make them good for you.
And Claire, I like what you said earlier is, there's so much out there to help families with. I mean, if you think about all the other payment options, whether it be a very specific payment plan, military related incentives, co-ops or internships, alternative loans. I mean, there's a lot. 529, we could spend a full hour and a half on 529s alone.
Yeah.
But so, yeah, I think that the really neat thing is, for those families that are really wanting to dig into this, having a game plan is huge, right?
It is absolutely. And anybody who has a kid, it's really easy to say, well, you just save for college, like start young, do as much as you can, and you'll be fine. I have a 14-year-old and I see the college costs, and we saved, but maybe we didn't save enough. Maybe we have to think about other things. What are our options? What's forgiven? What do we have to pay back? These are all things that that parents think about, and it's different for each school, and knowing how to navigate not only the laws that are constantly changing, it feels like, but also, you know, the ins and outs of the institutions themselves and what they're after is really going to help you if what you're focused on is like trying to get everybody through college or trying to, you know, not have to tap into your retirement accounts to do it. Yeah.
Okay, we have another question. What if a child has an investment account with Brio? Is that looked at? Does it depend on the age or?
It does.
Okay.
Yeah. So if they're over 18 years old, that is going to be just their regular brokerage account. So that falls into the bucket of the student's assets. That's going to be looked at as a 20% on the FAFSA. So 20% of that account, they're going to say you should probably spend that on college. It's your college, right? So, I mean, pros and cons to that. And so the CSS is even more than that. They say, you know, 25% of whatever is in that account, we're going to expect you to use that for college. So those are your own brokerage accounts. If it's your brokerage account and you're over 18, maybe come talk to me. There might be some options. If it's a custodial account and you're under 18, we could transfer that out into different things before you apply for the FAFSA in order to have it count less. It's not going to go away. It's not going to be 0, but it'll count closer to 5 instead of 25.
And that brings up a good point, Claire. How much time, let's say, you know, Pat does want to move some accounts around to sort of make his assets or income look differently. How much time do you need to do that?
That's a great question. Yeah, so it used to be, and it probably is up until the end of this year, that you self-identify assets in the 2022 and 2023 FAFSA. So the October of next year, when you're applying for FAFSA, this is all going to come from your tax return. So it needs to be happening before that, right? It has to be from this year's income because you're going to be using the previous year's tax return. So that's a great question. And, you know, I said I wouldn't cover any of the FAFSA changes, but there's another important one that's coming up because it's happening, because the tax return information is changing. It's coming straight from your return. Who claims the child, if you're divorced or separated, becomes more of a tax return issue than it was before, which is just who is that child with most of the time. And, you know, this is relevant to me. I have 2 children from my partner's first marriage. We have our own little terrorist. But so, you know, this is planning that you need to think about if you're divorced or separated, like who's going to claim the child on the tax return is whose income and assets are going to be counted for financial aid. So that's important.
I was going to ask you that because we're actually not married, but I do head a household and I get 1 kid and then he gets the other 2 and we keep our assets totally separate.
Yeah, we should talk. We should talk.
Yeah.
I feel like there's a ton of planning that we could be doing for you guys. Yeah. Yeah. It's so hard to get everything in 1 hour. And it's different for everybody, you know, but that's a big thing.
Okay, good to know.
Another question.
It was great.
Another question here, Claire. Is aid more possible if it's an out-of-state school?
It depends, right? If it's an out-of-state school and it's, you know, you live in Texas and you're trying to get into Berkeley, probably not, because they have 1,000 trillion people applying every year. It's hard and they don't need to. So in that context, probably not a great shot. However, if you're, you know, in California and you're applying to something in like Illinois and it's, you know, not maybe like a top 20 school, then yeah, chances are they're probably going to want you because you're going to pay more than their in-state people, right? For at least the first 2 years. And that's good for them. And so they want to get you in the door. That's the most important thing. So okay. I would certainly keep your options open when it comes to that.
And correct me if I'm wrong, Nancy, but is this University of Texas for a Californian? Is that the question? Is it? Yes. So do you expect the University of Texas would provide more aid to a Californian applying?
We're going to have to look at your EFC and all the other kind of factors that go into it. But Nancy, if you want to shoot me an email next week sometime, we can look at that stuff together. And I'll be happy to go on that College Board website with you and we can do that together.
Claire, for my own personal edification, if it is, someone, I understand that graduate school is a whole different animal, correct?
It is.
Okay.
Yeah, it is.
And what if someone were going to undergraduate and were, technically an adult, at 23, they decide, or 32, they decide, I want to go for my undergrad.
Yeah.
The parents'
So
income applies, can apply, doesn't apply.
It's whoever is claiming that person on their tax return. So
Okay.
if that person is working, then it's going to be their income, which in many cases is going to be better for you.
Right.
Because
They'll be making
maybe your
less.
parents have, and you probably have less assets than your parents, right? So this is all going to be a factor. Although I will say that so the FAFSA and pretty much everything that we're talking about today has only to do with the first bachelor's degree. Really doesn't matter how old you are. It's that first bachelor's degree. Everything changes once you get a bachelor's degree and you want to go to grad school or a PhD program, or you want to get a second degree. There are still things that you can do to lessen the cost of that. But I think from the government perspective, you're much less forgiving. And from an institutional perspective, it's very, very merit-based. And if that's your situation, we can talk about that, because there are some schools that are more easy to talk to than others.
Wonderful. Well, Claire, this has been so great. And as we're keeping her from her child's 8th grade graduation right now,
About 10 minutes.
I'd invite anyone to reach out. She's gone for the balance of the day, clearly, to celebrate this milestone. Reach out to me, and I'm happy to schedule some time for anyone with Claire to kind of dive into this further. So, that's what we're here for. So just let us know how we can help.
Thank you. Super informative.
Okay,
Awesome.
great.
I'm so glad you liked it. Pat, I will call you on Monday and we can chat. Okay.
Okay.
I'm
Hopefully
sorry,
you'll have your voice back by then.
We're going to laugh about this for years to come. All right. Well, you guys have a great day. Thank you for, sharing your time with me. I'm in the trenches with you, like literally, because we all have kids that are going into freshman year, and yeah, it's a pretty interesting landscape. So I'm happy just to chat about it as a parent, but I also want to help you make good decisions going forward. So thanks for joining.
All right. Thanks, Claire, and enjoy the afternoon with the fam.